What's going on, guys? Welcome out to the channel. Welcome out to another video. So the Federal Reserve has released another announcement that we're going up another 25 basis points on the federal funds rate. And we have already seen a large number of recent layoffs from large companies. And many people are thinking, where do we go from here? Where do we go from here? And where does the stock market go from here? Generally speaking, the stock market tends to pull back and head lower, crash, collapse once the Federal Reserve releases announcements that the interest rates are going to be rising. But I don't know if you guys have noticed, the stock market right now is pretty close to hitting all-time highs. And so a lot of people who have been trying to time the market, waiting for the stock market bottom, they've been waiting for a while. The stock market, the S&P 500, the NASDAQ, the Dow Jones Industrial Average is not necessarily doing what many people have expected it to do. Now, I've been an investor for many years, traded on multiple different platforms, TD Ameritrade, Charles Schwab, E-Trade, back in the day, just, day tech, some companies that aren't even around anymore, but I changed my perspective. And when I changed my perspective, this changed the game entirely for me in terms of making money in the stock market, growing my net worth, and growing my portfolio. And I want to share that with you guys. Now, when you think about it, the stock market, the S&P 500 specifically, this is the benchmark index. The S&P 500 contains 500 of the largest companies on the stock market, largest U.S. companies on the stock market. Now, this includes the tech companies like your Apples, your Amazons, your Microsofts, but it's also got your Procter and Gamble's. These are the largest companies, U.S.-based companies in the stock market. But what's really interesting is that a lot of these U.S.-based companies, they are also with international reach. So what a lot of people don't realize is that even if the United States didn't necessarily have the best year in terms of investments, most of the companies that you're invested in, if you are invested in the S&P 500, you more than likely have international coverage anyway. But something that was really, really interesting, that really just kind of changed the game for me, because I used to always try to time the market, trading in and out of stocks, listening to all of these different financial gurus on TV, and all it did was cost me money. I would lose so much money trying to trade the market. Now, for those who can, great. But I tried for a long time and it didn't work out too well for me. Now, what I looked at is the S&P 500's performance for a long period of time. I looked at what was the rate of return for the last 90, 100 years. And based on what it has done over the last 90 to 100 years, it allowed me to build and craft a plan to build wealth over long periods of time. But one of the keys to the success of this plan was to be consistent, doing it day in and day out, regardless of what the market is doing, regardless of if the Fed raises interest rates, regardless of if the Fed reduces interest rates, if, there's a Russia-Ukraine war, whether or not there's whatever's going on in the labor market. What is the inflation rate? None of this impacts the decisions that I'm making based on this dramatic shift that I made in terms of my investment strategy years and years ago. So you got companies like Charles Schwab, you've got companies like iShares, Vanguard, BlackRock. There are several different companies that have put together ETFs that have made investing an incredibly easier task than it had been in the past. If I wanted to try to mimic the performance of the S&P 500 on my own, I'd have to buy 500 different stocks, and I would have to be trading in and out of them on a regular basis and studying up on the stock market on every one of these stocks on a regular basis. And I just don't have time for that. And if I look at the stock market's performance over the last 100 years, I know that I'm going to get somewhere between 7 and 10% rate of return. So if I can contribute, say, $1,000 a month, that's about $250 a week, I will generate somewhere between $170,000 and $210,000. Actually, I will generate between $177,000 and $210,000 in 10 years. That's with only $1,000 a month. And granted, some people are not going to be able to contribute $1,000 per month, but most people, if they budget properly, they can find a way to make that happen. Me personally, I had to cut back on a lot of expenses. I remember the first time I ever decided to start contributing to my company's 401k. It was the hardest thing to even conceive, because here I was used to getting a paycheck of a certain amount, and then all of a sudden I'm voluntarily reducing my paycheck size because I'm now contributing to my company 401k. It was the hardest thing to even think about doing, right? But I started off by contributing just 1%. And by contributing just 1%, it was so small that I really didn't see it that much on my paycheck. But the cool thing is it got me started. And I tell people all the time, it doesn't matter if you start off with a lot. You can build a lot of wealth over a long period of time. But the key, and most people completely overlook this, they undervalue the habit that is formed by simply starting. Because you'll be surprised. Number one, you'll figure out ways of increasing your income. You will figure out ways of increasing your income if that is what you're interested in. If you want to increase your income, you'll do it. But two, you'll learn how to live on less than what you make. Delayed gratification. I can't tell you how many times I've gone out, and I still do it now. I go out and I don't frivolously spend money. I did that when I was younger, and I stopped doing that because that is one of the greatest ways of destroying your wealth. Being a frivolous spender, not having a plan for your money, not having a budget, and just, letting life just take full advantage of you. That's how you stay broke. So if you want to stay broke, follow those steps. But if you want to build wealth, you have to have a plan for your money. And that includes when you go out, not just buying, things that are not within your budget. Now, once you get to a point where you can afford doing these things, do whatever makes you happy. But if your goal is to achieve financial freedom, you got to have a plan for your money. So once I started doing this 1% contribution to my 401k, well, guess what? After about 4 weeks, I had gotten used to the new paycheck amount. And at the same time, I began to see these contributions hit that investment brokerage account. Now, you don't have to use Vanguard or E-Trade or M1 Finance or Webull or Moomoo, or use whatever brokerage account you want to use. I'm going to do my best to try to leave a link for you guys down below. Some helpful links for different brokerages that, I might be recommending. You guys can check that out if you like. But the key is to build the habit of simply investing on a regular, consistent basis, dollar cost averaging. And, this is just my own personal experience. This is not investment advice. This is purely for entertainment purposes. But this is what I've been doing for about 20 years. And at some point, I would say probably by 6 weeks, I had decided, hey, I'm going to go ahead and bump up this contribution to 2%. And when the 2% started coming out, it was less painful than the 1% contribution that I started to begin with. Why? Because I'd already gotten used to the expectation that, hey, my paycheck, my spendable cash is going to be a little bit less because I'm contributing to this investment account. But the magic happened for me was that I began getting happier seeing the investment brokerage account growing over time. And so I realized at that point, wow, the more I sacrifice up front, the more gratification I'm going to have on the back end. And I realized that I'm going to be able to generate passive income and dividends and capital gains and great returns on my investment over a long period of time, as long as I keep doing what I'm doing. And so at that point, I no longer became so hung up on what's going on in the stock market and how the Fed's latest decision is going to impact, my stock's performance, because I'm not trying to sell tomorrow or today. So in the short term, it doesn't matter. And yes, in the short term, there will be volatility, but in the long term, I already told you guys, only $1,000 contribution will get you to somewhere between $177,000 and $210,000 if you're making that contribution monthly in about 10 years. And that's a substantial amount of money with a minimal amount of investment. And the crazy thing is even if you didn't contribute any more money to that amount after 10 years, that money will continue to grow and compound. So just imagine, like, every roughly 7 years, that money is going to double. Even if you never put another dollar in there. That's compound interest. That's growing your wealth. That's increasing your net worth. That's reaching financial freedom. But it's going to take some upfront sacrifice. Now, I had gotten to a point where, my goal was to contribute the maximum amount that the IRS would allow you to contribute, which was like, I think it's like $20,000 a year or something like that. So not only was I getting the free money from the employer match, but I was also getting the compound gains and growth from the stock market, but also my gains were not being taxed or are not being taxed while they're growing. So, it's a double benefit. It might even be a triple benefit if you think about it. And in addition to that, as I would get raises, let's say I got a 3% or 6% raise, I would take half that raise and bump up my contribution by that amount. So let's just say I got a 6% raise. Well, I'm going to go ahead and increase my contribution by 3%, and then I'll take that other 3% and just use that as spending money, right? But the thing is I prioritized saving, but not saving money just to keep my money in the bank. But I prioritized saving so that money will be available to be invested and compounded. Now, after this, I went ahead and created additional streams of income by creating additional savings accounts or savings bank accounts that would later be used as seed money to start up additional streams of income or small businesses. Because a lot of people don't consider the fact that they can invest in themselves. Yes, you can invest in the stock market, but let's not forget about the fact that you can create a company that you control, and then you have 100% equity. So drop me some comments, you guys. Let me know if this makes sense to you guys. And one last thing I wanted to leave you with is to really accelerate that growth. My goal was to reach a point where I was contributing somewhere to, between 50 and 70% of my income, meaning that I'd have to continue to prioritize investing. And by doing that, I'm not increasing my lifestyle as my income is increasing. And this is a big flaw that I had seen in America quite a bit. Most people increase their lifestyle so fast that it puts them in a very difficult financial situation to be able to build wealth. And then when a recession comes, or the Fed decides to raise interest rates, making borrowing costs more expensive, it makes mortgages cost more, it makes car payments higher, it raises the cost of borrowing money against your credit card. These are the people who have allowed themselves to be in a situation where they're vulnerable to Federal Reserve and economic moves and changes, which will always happen. So don't let yourself be caught off guard. Pay attention to your money, guys, and make sure you have a plan for your money. So anyway, guys, if you made it this far in the video, do your boy a favor, drop a huge like and subscribe to the channel, and drop me some comments. Let me know what you guys are thinking. Let me know what you guys want me to talk about in the future, and I'm going to catch y'all on the next one. Peace.